Hi, I'm Lewis Jackson, and today we're diving into the Gather, Grow, Gift strategy with crypto assets specifically, because we want to use these digital assets, these crypto assets, to build generational wealth, but also by minimizing your tax exposure. So this is going to be a step-by-step guide tailored to high net worth individuals who are serious about creating some sort of systemic independence and leaving a legacy for your family behind, and doing so with your crypto. By the end of this video, you're going to actually understand why this strategy is a cornerstone for the wealthy. This is what the wealthy already do, and how you can apply it to your crypto portfolio. So the first thing, and many of you have already done the first step of all of this, and that is the buying. Essentially, what we're talking about here is buying assets that are going to grow in value. This isn't about buying cars or buying things that are liabilities instead of good assets. These are assets that will grow in value. So if you've bought Bitcoin, for example, and you bought it many years ago, that's an appreciating asset, probably the best or the most appreciated asset that you have currently, unless you bought property probably like 50 years ago and you've watched that single property go up as well. Property is one of those things as well, an appreciating asset. Now, the strategy we're about to go into today will allow you to hold these assets. First of all, you have to have the assets in the first place. Take that capital appreciation, but not take any capital gains tax. This is what all the massively wealthy people do. When you look at Elon Musk, for example, the amount of things he's done using this method has allowed him to get to the status he is and the wealth that he has reached. It's also allowed him to invest in all these other companies. And when we talk about appreciating assets, we're talking about cryptocurrency and digital assets. For Elon Musk, for example, an appreciating asset for him would be investing into a new business and growing that business to be one of the biggest companies in the world. He did that with Tesla. He's done that with, because he started in PayPal, sold his share in PayPal, used that money to buy and invest an appreciating asset in Tesla and the Boring Company and all of these other ventures that he's taken. This was done tax-free. The growth was done tax-free. So when we're looking at the growth of Bitcoin or the growth of XRP, for example, you can do all of that without taking any capital gains tax if you use this process. But you first have to buy. And that's step number one, which I'm going to write right here. Step one is you have to buy assets that go up. So you have to buy these assets that go up. If you're buying assets that maintain or go down in value, depreciate, it's not going to work. You first need to buy assets that go up. Very simple. We've likely already done that. You've already likely seen growth in your portfolio at this stage as well. So you're doing great. The next step of this process, step two, this is what we're calling growth. Many other people call this the borrow phase. This is exactly what Elon Musk is doing to build his wealth. We're going to do it specifically with cryptocurrency though. One thing I've left out about step one is that it can't just be assets that appreciate in value. They have to also be assets that you can borrow against. You have to be able to use them as collateral. This is going to be the key in removing tax for the growth of the appreciation of the asset. So, for example, we buy a house, for example, and it goes up from $500,000 all the way up to $1 million. We've seen $500,000 of capital appreciation there, capital gains in many ways. But we're not going to pay any capital gains tax on that because we're not selling that property for that new price. This is the key. You're not actually selling the asset. If you sell the asset, you trigger a capital gains tax thing to happen. You're going to have to pay the IRS for that. And that's going to be really steep. So not only have you lost the asset, but you've also paid tax. And the tax, certainly in the UK, but I know the US can be steep as well, depending on the state. So you want to be buying assets not only that will grow over time, but also can be collateralized. And collateralization essentially means, here's all of my crypto. You give it to an entity, here's all of my crypto, and they say, we'll give you a loan to value, we'll give you a loan on that. And that loan specifically, in this borrow phase, is tax-free. So let's say you've got $1 million worth of crypto right now, and you want to get a loan on that. You want to collateralize it. typically what these different places, like you'll have Nexo, you'll have BlockFi, even there's some others, and even some more traditional banks are now starting to offer this, which is a really big step towards making cryptocurrency and this strategy really useful in everyday life, because they're getting ready for all the rich people, right? They want to provide services, they want to make money from the new rich people. You're going to be one of those, so pay attention. So you can actually get a loan from one of these places. Let's say you've got $1 million worth of XRP, which many of my clients actually do have this much, so you can actually apply this into your own strategy. Nexo or BlockFi will give you a loan to value. So a loan to value is the amount of loan that they will give you as a percentage versus the value of your asset. So the value of the asset is $1 million. If the loan to value was 50%, they would be happy to give you, and this is what's great about cryptocurrency and blockchain, you get this loan immediately. You don't need to wait for the bank to allow you to do it. It's instant. They're like, okay, you've got $1 million worth of assets. We'll give you 50% loan to value. Here's $500,000 that you can use tax-free right now. Tax-free. And so what these really rich people are doing, like Elon, is they're taking that collateralized value. Obviously, you've got to pay back this loan at some point. Of course you do, but you're not paying tax. You're paying back the loan, but you're not paying tax. That's why they move that 500,000 and they buy cash flowing assets. So assets that increase in value themselves or generate an income, and that income pays off the loan. And what happens is, once you've paid off the loan, you're now able, you now have the asset that you bought with that tax-free cash. So if I bought a home to rent out to people at $500,000 and I paid back the loan in full, I paid back the $500,000, I'm now left with a property that generates me cash flow. And I used tax-free money to do so. So let's go back, because I think we're understanding that. The important thing here is that you have to be buying assets, or using this strategy, using assets that you can collateralize. Now, what's unique about our situation is that in the world of crypto, this is a new thing. Being able to collateralize your assets is a new thing, so we're relatively new to it. And so this is becoming more of a possibility. And like anything, if you're early to a new possibility, you're likely going to make the most amount of money. So step one is obviously to buy the assets, to gather the assets. Step two is to borrow, which is to grow the assets, so grow your wealth in these different asset classes, and different cash flowing assets. But then step three is an inevitability for all of us, and that is that we're all going to die. I say this a lot on the channel, but we are all going to die, and there's a big concern for many of us who have family that we're trying to build this wealth for. What happens to them when I die? When I die, do they now get loaded up with this whole tax burden that I've left them with? If my assets have grown to $10 million and now they get the $10 million, are they going to have to pay $6 million in tax because I died? Well, there's plenty strategies to mitigate against that. This whole process, this 3-step process, buy, borrow, die, gather, grow, and gift, is a tax-free system. So despite all of that, we're going to remove tax from the whole system, even in the inheritance phase of this as well. Because ultimately what we want to be doing here is buying good assets, borrowing against them, tax-free, and then dying strategically. So let's get into the death part. So this ties into this generational wealth kind of legacy planning thing that we're doing here. When you pass away, your children, your family are going to inherit your crypto assets with a stepped up cost basis. So what does that mean? Well, it means upon your death, the market value of your crypto becomes the new baseline for calculating capital gains. So let me give you an example about this. Let's say you originally purchased about $1 million worth of Bitcoin, which appreciated to $5 million by the time of your passing. And let me just write this down here. So you bought $1 million worth of Bitcoin and it's grown to $5 million, right? So you've grown those assets. Now, when you die, your heirs sell the Bitcoin for $5 million. But because of the step up in basis, they actually owe zero taxes on $4 million of it. So for example, what they're essentially going to do is they're going to pay any loans that you had off when you die. Maybe they don't. Maybe there's a way to continue the loan. That's absolutely possible. But let's just make this kind of worst case scenario. Let's say this $1 million worth of Bitcoin was actually borrowed. Like, this is borrowed money. And so the loan you have to pay eventually is that $1 million. That's the loan that you have to pay. But the assets have grown to $5 million. So when you die, they pay that $1 million loan off, meaning they're left with $4 million, and there's no tax, no capital gains, because the new stepped up cost basis becomes the price of the asset when you die, not when you bought it. It's a really, really important distinction there. That's what a stepped up cost basis is. They step it up to bring it to the moment of death when it was transferred. That's the new cost basis. And so now they are left with $4 million in Bitcoin, tax-free, which they can, if you've taught them properly and you've taught them how to steward these assets correctly, which is what I'm kind of doing with my clients here. We're diving into the family a lot in terms of teaching the family how to steward these assets properly as well, to continue on what you've learned and what you've become so smart in handling over the last few years. So now they end up with $4 million, and maybe they take a loan on those $4 million and buy capital appreciating assets like more cryptocurrency, maybe a business, whatever it is, and they grow that 4 million even further, again, tax-free. And in the meantime, you've actually borrowed against that 5 million during your lifetime, and you've lived tax-free and left behind a tax-efficient legacy. For everyone who's concerned about leaving outstanding loans or kind of pairing this strategy with a life insurance policy, that ensures that any of the debt is covered when you pass, right? So that's the key thing. When you've got that debt, let's say that that outstanding debt when you die, but you have a whole life policy, for example, that whole life policy will pay it off, will pay off that loan, leaving them with that amount that's tax-free at the end. It's wonderful. Like, you spend your whole life not paying tax. So your whole family, all your heirs, are basically left completely unencumbered by these assets. So you can also have like a whole life or an indexed universal life policy, and that works particularly well in these scenarios, which I would really advise. And even to go a little bit of a step further here, you could even establish a trust that manages the crypto assets and the loans, because trusts actually provide you with a little bit of an extra layer of protection and privacy, and a little bit more control over how your assets are actually distributed to your heirs, technically, at the end of the day. So let me give you some bonus tips here at the end. You can use stablecoins as a really useful tool here. When you've actually borrowed against your funds, have them in stablecoins, because that means you're not exposing yourself to the market volatility. There's a whole strategy that I'm going into with one of my clients here specifically about how we play this balance between the market volatility and increased borrowing and reduction in the loan payment. So there's a lot of ways to do this, but there's too much for this video probably. The second thing is that you want to integrate some sort of insurance into this whole thing, because with one of these insurance policies, you can actually pay off any outstanding loans in your passing. That's what we talked about a little bit earlier. Number 3, you want to have a little bit of diversification. So you want to borrow against your crypto assets and reinvest in other appreciating assets. You might like real estate for that, or dividend paying stocks, whatever it is. You want to be using the borrowed money to invest in cash flowing assets or appreciating assets, not a Lambo. Okay. The fourth bonus here is that we want to kind of try to manage the risk a little bit here. I talked about loan to value ratios earlier on. Many of these platforms will offer you loan to value ratios that are significantly higher than I would be comfortable doing for myself. And the number I'm comfortable with, you can take this as a little nugget. You can have whatever number you want, but for me, a 30% loan to value seems to be relatively reasonable. It will protect you if the markets come crashing down, but also allows you enough capital, sufficient capital, to do some damage in the growth and the appreciation of the asset as well. But that's just my rule of thumb. So this whole buy, borrow, die strategy isn't about avoiding taxes. It's about creating a system for independence and ensures that the wealth actually serves your family. So when we talk about generational wealth, this is the generational part. This is allowing the generational part to happen while also allowing you to not have to pay any taxes on this stuff. This is what the most rich people in the world do. And we can be applying it to our lives, even if we're not rich like Elon Musk. But if we've got $500,000 up to $1 million, $10 million, we can be applying this on a smaller scale on our own. So if you know someone who would be interested in hearing this, or this was of interest to you, I would like you to share the video with them, but also let me know in the comments below if this resonated with you and you want to talk further about applying this strategy into your life and applying this into your family as well. You can follow the link in the description. You can book a call with me and my team, and we'll discuss how we can make this happen for you. Anyway, that's all. Thank you for being here. I'll see you in the next one.